Life insurance is not a get-rich-quick scheme by any way, shape, or form. But if it's well designed and you're using it the right way, it can actually be a way to make a lot of money with life insurance. So it takes strategy, education, and a really well-designed policy to make it work in your favor so you can make a lot of money. So in this video, I'm going to go into exactly that, is how can you make a lot of money with using life insurance. All right, so the first point is, number one, life insurance is not an investment. Never has been, never will be, at least in this sense, especially when it's dealing with whole life insurance. It's not an investment, but it is a very good tax-free savings account. That's what it is. Here's the thing. You have your bank money, right? You put your money in the bank savings, you make maybe 0.nothing%, and then guess what? You get taxed on it. And I can already hear somebody in the comments saying, you say 0.nothing%, but I have an online savings account paying me 4% or 5%. Well, congratulations. I don't care, because the truth is that's not going to stay there long term. And secondly, you're going to get taxed on that 4 or 5%, where I could be making tax-free money at 5 or 6%, and it's completely tax-free, no taxes taken out. So unless you're in a 0% tax bracket, you can go comment down the road. And by the way, your comments are awesome because it just makes our algorithms better. So keep commenting. Anyways, so moving back to this, life insurance is not an investment. It is a savings vehicle. However, you can use it with investing, and that's where the real magic can happen with this. All right, so what are the best ways to invest with using the life insurance as your savings vehicle? Notice what I said there, not an investment. The best way to do that, of course, is I like to use it for real assets or things that pay me income, especially in the shorter term. So when someone says, oh, I got this investment I'm gonna do, and I'm gonna have to wait 20 years to get paid on it, not the best investment. Why? Because here's how it can work when you're using life insurance. See, with life insurance, there's the death benefit. We're not talking about the death benefit here. We're talking about the cash value. The cash value, that's that tax-free savings account. And that's the money you can use. Now, you can withdraw the money out. You always have that option. But the problem is when you withdraw money out of savings, what happens? Balance goes down, and the interest you earn goes down with it, doesn't it? Well, what if you could have the balance all there? What if you have the money all there, still have access to the money, and use that money to invest too? It sounds like the best of both worlds. It sounds too good to be true, but that's exactly what you can do with whole life insurance. You can actually go to the insurance company, ask for money from them. You borrow money from the company, leaving your money alone to keep compounding interest, while you then take their money and invest it. Now, here's the thing. It's not for free. You do pay interest to them on that money, and the interest is roughly about the same as what you're earning. The key is this. If you want it to really work, and this is very important if you remember this, is that you've got to have some kind of investment or asset that's going to start paying you income. And ideally within a year. That's my preference. It doesn't have to be, but if it's within a year, it tends to make more sense on the numbers, because the thing that works is that when you're paying on a loan, it's simple interest, like all loans are, versus compounding interest like savings accounts are when they build and grow and compound on each other. Compounding interest grows faster than the simple interest that you pay down. So when I have an investment, right, I want to get that money from the insurance company, which is using my money as collateral when they give you that loan. You go and invest that. If that money's paying me monthly, I'm taking that monthly income and paying it towards that line of credit to pay it down. That's why you hear people out there say, you pay yourself back. No, you don't. You're paying the insurance company back, but everything above and beyond the interest, yes, you are paying down that line of credit, that loan balance, that allows you to free up more money to then use again. See, understand that most people, when they invest, they usually go and pull all their money out from that savings account or checking account, use it to invest. And then they take the cash flow from that investment and use it to slowly build up that cash savings until they finally have enough money to then invest again, right? Now you're able to take that money, use it to earn money, but remember, you're still earning interest over here. So you're earning money in two places at the same time. So having those investments, when they pay you monthly or even quarterly, right? And annually could work too. But if they're paying you on a pretty regular basis, you can use that money to pay down that loan, keep the interest from compounding against you so that there's less and less interest being charged while you're earning more and more interest on the other side. That is the secret of how you're able to make money in two places at once. If you don't do it that way, if you're just letting your loan compound against you, which you could because there's no monthly payment required, what happens is then now you're having a race about who's compounding faster. And it doesn't really work. So you got to have it where you have cash flowing investments helping you pay that money down. So I had one client who was a father that had two boys. Now, he already had his own infinite banking policy, and it was okay, but nothing great. The hard thing is I had a friend that did it for him. I didn't want to get rid of the policy. So we ended up putting policies on his two kids. Now, the one thing that many people don't realize is that you can put policies on your spouse, your children, heck, you possibly even do it on your grandchildren if your children have policies too. You can even do it on business partners. Anybody you have a financial self-interest, you can put a policy on. So he decided to put $12,000 a year into each of his sons' policies. He had 2 sons. So $24,000 a year. He's been building up that money in their policies, almost like it's their college savings account, but instead of just building it up and gambling in the stock market like most people do, he's building up that money to then invest in real estate. And then as that money comes back, he uses that to pay back that line of credit, build up the cash again, to invest again. And the cool thing is because you're earning more interest than you would just liquidating your savings account, because you start to compound faster, the great thing is now he's got more money to invest and create more cash flow from the investments, which, by the way, pay for his kids' college, right? They got enough cash flow coming in to help pay for those kind of things. Even if they get student loans or whatever for the next 4+ years, they're still okay. So there's a lot of ways you can use it that you can invest it however you want. And that's a great thing. There's no limit to where you can invest it. Oh, by the way, here's a bonus tip. Many people say, well, I've got an IRA and I've got this. Can I use them? Can I use the IRA to fund it? The answer is no, you can't, because you would get taxed on that money if you try to do it that way, because this is tax-free where IRAs are taxable. So you can't use the IRA to fund it. So you could instead do this. Like if you have an IRA, you can make it a self-directed IRA where you can invest it almost anywhere you want. But I usually tell people, if you're looking to invest it, invest the IRA money in places where you're going to get taxed all the time, right? Invest in those places. But places where you get tax advantages, if you did that with an IRA, you would lose the tax breaks. Like for example, a real estate property, like when I buy a real estate property, I can depreciate the property. That means I save money on taxes. But if I put in an IRA, all that's gone. I lose it. So instead, I use my infinite banking policy to put as the down payment on those properties, so then I get to keep all the tax benefits I normally get. This is true with like oil and gas, where oil and gas I get tax benefits. Same thing. I don't want to put that in an IRA. I would rather use my own cash. If you have a business and you want to make sure you get the business write-off, the cool thing is you can almost not just double dip on your infinite banking policy, but triple dip. Because not only are you able to make money in 2 places at once in your business as well as inside the policy, but you can also write off the interest that you are paying to the insurance company, getting a tax break. So now you get even a better advantage because it's a business expense. So there's a lot of different ways you can use it to help improve your returns on your investments. So here's a concept I call the wealth wheel, right? It's pretty simply this. The wealth wheel starts out where you've got your cash savings. You use that savings to fund into the policy. By the way, I recommend that you start to use your emergency fund to fund the first few years, and then you start to add more and more of money you're already saving anyways over these previous years to keep it going and growing. So you use that money to go into the policy. Then you leverage that policy eventually when you got enough cash in there beyond your emergency savings to then leverage that to go buy assets, cash flowing investments. The cash flow from those investments now come in to pay back towards the line of credit, building up the cash you can then turn around and invest again. So remember, if you got an extra $10,000 you took out from that investment in returns to pay down your loan, that's now $10,000 you can turn right back around and loan out again. And so here's the cool thing. You don't have to pay the loan back if you don't want to. Now it helps, but you don't have to. Another client example of someone who did this very cycle is a woman that she actually had $125,000 she put into an investment deal with her and her son. They did the deal. A year later, the money comes back and they made $155,000. So they made $30,000 more. Her question to me was, Chris, should I pay back the entire insurance loan or should I just reinvest my money? I said, well, do you have an investment lined up? And she said, yeah, I do. Great. Well, instead of just paying back the entire loan, you could pay back some of the interest, which was like maybe $6,000 for that year. Pay back some of the interest, but that still leaves you another $25,000 plus. It really still about $150,000 that you have. You can then use to reinvest. So yeah, you paid the interest, but you didn't have to pay the loan off. You can keep it going forever. Oh, here's another benefit. 401ks, if you've ever tried to take a loan from there, you can only do one at a time. Here, it's like a line of credit. You can take out as many loans as you want as long as you don't go above about 95% of whatever cash is in there. So that's what she did. She's like, great, I'll pay some of the interest and the other $150,000 back out to invest again to generate more income the next year to come back and decide what I want to do with it then. So the cool thing is you can always pay towards that line of credit, freeing up the cash to store it and use it however you want. I know especially in 2022, 2023, a lot of people were scared to invest in anything. I mean, heck, Warren Buffett's got literally $167 billion just sitting in cash right now that he won't invest because he doesn't see any good buys right now. Great. Why not store in a place that you get not only is tax-free, but it grows more than you would get in a savings account. And here's another benefit over a savings account. It's actually, in most states in the United States, protected from lawsuits and creditors 100%. Doesn't matter if you have millions sitting there, they can't touch it. Just like Hammer, right? You can't touch this. Like, it's protected. So that's one of the great benefits you have and be able to keep it there. So getting back to how do you make money with whole life insurance? It's not the whole life insurance itself, it's what you do with it with the other investments that make all the money. And this includes even your own business. It's having that cash available to use that allows you to get extra leverage on your money by making it in two places at the same time. If you want to go further down this rabbit hole, go to our website, moneyripples.com. We got a whole infinite banking section that you can click on and actually learn deeper about how this works and how it could even work in your situation.